2018 over, we thought it'd be useful to look at our past blog posts from last year. We get a lot of great feedback from readers and from clients, which tells us if we're writing about issues that resonate with people and helps us decide what to write in the future. 2018 was a tough year. In fact, 4 out of the last 5 years, energy has been the worst performing sector out of the S&P 500. Distributions on AMLP, the big MLP ETF, are down 34% since 2014. And that really does illustrate what we think is the issue, is the industry has been wrestling with how to pay for growth. And ultimately that's led to distribution cuts. We wrote about that with Kinder Morgan. Kinder Morgan used to have a slide in their presentation deck, promises made, promises kept, until they stopped keeping those promises and had 2 distribution cuts and an adverse tax outcome on the way to simplification. Rich Kinder, the founder of Kinder Morgan, generates a lot of strong feelings, and we got hundreds of comments and page views, thousands of page views on that. Energy Transfer is another one. They were a little bit more stealthy in how they cut distributions because their MLP affiliates cut distributions on their way to combining with the parent Energy Transfer equity. So we wrote Energy Transfer, cutting your payouts but not mine, to really illustrate that. And Kelsey Warren, Energy Transfer's CEO, also draws a huge amount of interest whenever we write about him. We also noted that last summer, Kelsey Warren said that even a monkey could make money in business right now. And in fact, Energy Transfer has performed really well on an operating basis, but their stock slumped 25% in the balance of the year, even after business continued to improve. Earlier in the year, we wrote about the taxable MLP dedicated funds that pay corporate income tax before they distribute their returns to investors. MLP dedicated funds didn't really show the impact of that tax drag last year because taxes are paid when the market goes up, and it was a tough year. But when you have a good year in the sector, and we think that's coming, the tax impaired structure is really going to hurt them. We wrote several blogs on valuation. We wrote one on Enterprise Products Partners, valuing MLPs privately, how a private equity investor would look at that company. And even though Enterprise Products is probably too big to be acquired by a private equity investor, many investors and clients of ours really appreciated the deep dive analysis that we did on that. The fundamental issue comes back to growth versus buybacks. How do you pay for growth and still maintain distributions to investors? We think that we're turning the corner on that. We think that the peak in CapEx is behind us and that you're going to see a slowdown in new projects in 2019. And we also think you're going to see dividend increases. We expect on the American Energy Independence Index, mid to high single-digit increases in dividends this year and next year. And we think that should really lead to an improved sentiment, a better environment for pipeline investors. 2019, we're looking for much better things from the industry. I'm Simon Lack. We invest in energy infrastructure.